Microphone time. Yes. Are they all on?
Yes.
We're going to have to share the microphone.
That's right.
So I'll leave them over here.
Yep.
I'll leave this one with Susan. We're going to have to share the microphone.
Okay, that's okay. You go first.
I did think we were going to yes,
This way? We'll be a bit flexible. How we missed the chair.
Yeah, I don't know.
Hi, pleasure, Eric from CDB.
Yeah. Oh, Eric, you said. This is German name Anders.
If you speak German, you can say Erich. I usually don't insist on it.
Yeah. Hello, everybody. Can you hear me? I think you'll be helped by the headphones on your seat. So thank you, everybody, for joining us today. My name is Victoria Walker. I'm on behalf of ILX Management. We are, in part, the host of today. We recently closed 1.7 billion on behalf of Dutch pension funds, ABP, PFW, and Achmea on behalf of pension fund Vervoer, and also some Scandinavian pension funds. So you may have heard of Sampension and Academiker. So on the first day of COP, we were able to have this very important announcement with the investment strategy of co-investing solely with multilateral development banks who are represented in this panel today, and with the aim of contributing directly to the climate goals and SDGs in emerging markets. We co-invest pari passu with the MDBs. We participate side by side, and we which is a proof in point that pension funds are willing to take the risk of emerging markets, and that the actual risk is perhaps a bit lower than the perception of risk in emerging markets. So I am joined here today with the pension funds of Velliv and CDPQ. And I am joined also by the MDB representatives. I would like to pass on to Jaime, Prince Jaime de Bourbon de Parme to introduce the setting. Thank you very much.
Thank you, Victoria, for opening the session, and ILX for really running this session going forward. We are going to unlock the institutional capacity to finance the emerging markets for climate transitions with the MDBs. There is no panel at this COP with so many MDBs present and with such important pension funds present as well. So this is quite a unique. We should be on the main stage, but online we are, and we're going to have a wonderful discussion. Here at this COP, this is a finance COP. This is not a between COP, this is an enabling COP. And we need to land a finance goal. And we need to land a finance goal that is both ambitious but also realistic. And that in a very dynamic world. And the renewable energy transition, the investments, IEA said, are going north-north. And not enough investment is going to global south. And if we look at the needs of the global south to be able to transition, they need $2.4 trillion US, and that's excluding China. And the public sector cannot finance that alone. We know that, the negotiators know that, so we need to leverage the private sector or to engage the private sector. Now, the role of development finance is that MDBs and DFIs are the primary vehicle for governments to fund investments in the global south. And that goes through grants, concessional loans, leveraged private sector finance, but also market-based lending, and I'm thinking of the IFC here. And if we look at the MDBs, it's one-to-one funding going in and leveraged funding from the private sector. And that number needs to go up if we want to get to the trillions that we need. And here, are MDBs that have more projects than governments can finance. So this is a huge investment opportunity. And the pension funds are seeking opportunities, and they do have trillions. So there is a great fruitful discussion to see if we can marry these two worlds and create a new asset class to invest in the global south. The title is clear, the MDBs are here, the pension funds are here, and we're open for that discussion. Yesterday we saw an announcement of MDBs. There's a joint statement that said MDBs estimate an annual collective climate finance for low and middle income countries of 120 billion, including 42 billion for adaptation, and the aim is to mobilize 65 billion from the private sector. So my question already is to you to think about it. What's the pipeline for private sector finance in all this? And that's the discussion we're going to have here. But I want to just come to you and just give you the microphone so you can quickly introduce yourselves and your function so that everybody knows. And I'll start here with the pension funds.
Hi everyone, Eric Krypton from CDPQ. That's the second largest pension fund in Canada, based out of Montreal.
Hi everyone, my name is Anna Stensbøl. I'm from the Danish commercial pension fund called Velliv, where I'm the CIO.
Hi everyone, Gabriel Azevedo from IDB Invest, and I'm the Chief Strategy Officer.
I'll give you your microphone back. Suzanne Gaboret, I'm the Director General of Private Sector for Asian Development Bank, covering everything ADB does in the private sector. Thank you.
Thank you very much. Mark Bowman, Vice President of Policy and Partnerships at the European Bank for Reconstruction and Development.
Good afternoon. My name is Mohamed Goulen. I am with the International Finance Corporation, World Bank Group.
Good afternoon. My name is Andrew McDougall, and I returned about 6 weeks ago to the European Investment Bank to run EIB Global, which is EIB's non-EU business. Nice to meet you.
Wonderful. Well, you can keep the microphone and then we can exchange it amongst yourselves. That's just one form of collaboration that we can already start on. So my first question is to the multilateral development banks. And again, thanks that you're here. It's quite a remarkable lineup that we have here. What is the opportunity from your perspective, from a financial perspective, but also to be able to deliver on your social mandate? And where do you see the opportunities going forward? Maybe I'll start with the lady in the group.
Thank you. The lone lady, if I could put it that way. No, there are lots of opportunities, but sometimes, as we see, there is this discussion on risk. And there's a perception on risk as well that we need to get over. So I think that across the board, we see increasingly opportunities across various sectors and various regions. Obviously, it depends upon which region that you're looking at. Infrastructure, as we know through a lot of the funds and a lot of the investments that we're looking at, is the primary area that we're investing in, followed by financial institutions, types of investments, so you can actually reach further and greater. Now, I think that, your point on mobilization, so last year in ADB, we were able to mobilize $2.7 for every dollar that we put in. So it's something that we're working really, really hard to bring in the private sector. There, like I said, across the board, there are opportunities, but there are limitations when it comes to the enabling environment, the policies that allow you then to invest in these countries, and combined with the risk appetite and perception of risk, it makes for a very dynamic situation.
Thank you very much.
Well, thank you very much. Just a quick word on the EBRD. We are absolutely focused on this agenda. This is one of our number one priority. All of our operations are now aligned with the Paris Agreement, and over 50% of our investments are now green investments. We invested something like $6.5 billion in climate finance last year, and actually mobilized something like 3 times that amount in terms of private finance. So an absolutely key priority for us. I think we all from these discussions here at COP, we all understand the scale of the challenge, the urgency of action. I think we also see the opportunities as well. And if you look at renewable energy as a very obvious example, the very significant opportunities for commercially viable projects for the private sector to be involved. And you've seen how technology has developed over the last couple of decades. And you've seen, certainly since the energy crisis, you've seen a realization by a great number of countries that green energy, renewable energy is not just the right thing to do in terms of clean, green energy, good for the climate, but it also makes economic sense. It's cheaper energy and it's more secure energy. So the scale of the challenge is enormous, but there are incredible opportunities out there. We know that public finance will not be sufficient. We know that the MDBs have a very important role to play, but we know that our key challenge is mobilizing the private sector and making that connection between large pools of capital and the opportunities that do exist. Making that connection is the key challenge, and I hope what we're going to discuss in quite some detail today.
And why do you think that the private sector has to invest through the MDBs in the global south? What's the value proposition or the service that you deliver that they can't do themselves?
Well, I don't think the private sector does have to invest through the MDBs. I think there are many different routes, and there's obviously a very good, well-established business model of the private sector being a co-investor in projects, and all the fantastic work that ILX has done. That's a fantastically successful model. So there's a key role for the MDBs in terms of investing on our own, demonstrating that projects are viable, using our experience and expertise to demonstrate that. There's a key role for the MDBs in terms of co-investing. There's a key role for us in terms of de-risking projects. But there's also a key role, and I go to the point actually about policy and the policy environment. There's a key role for the MDBs in terms of helping to improve the policy environment. And ultimately, we would like to get to a situation in our countries where the private sector would invest on its own. That's our kind of ultimate goal in terms of success.
Now I want to go to Gabriel, and then I'll go you last because you've got a very special, different sort of role within the World Bank Group. Go ahead. Yeah.
No, thank you so much. And basically, just piggybacking on what has been said, I was talking to Suzanne before the panel. All that's been said in terms of policy is really important. De-risking is really important. Our knowledge of the countries where we work, I think that's a comparative advantage that we bring when talking about mobilizing. But I think there are 2 points that I would like to make in addition to those points that were made. One, I think we need, as MDBs, when we talk about de-risking, I think we need to be bolder. No, we heard about clean energy and energy transition. I think that's a low-hanging fruit. I think those projects, they're viable in their majority. I think our role is to push the envelope on less traditional areas in which there is less comfort for the private sector. For instance, we are looking at forest regeneration in the Amazon, for instance, as a possibility. Transition minerals, areas in which there's a lot of potential, but no, you need someone to come in and learn and take the first risk. That's one. And for doing that, we need to transform ourselves. We need to transform our institutions. So in our case, IDB Invest, we are going through a huge transformation. And instead of saying that mobilization is our priority, mobilization is going to be our business. We are moving away from being the lead investor, from the traditional buy and hold MDB model, to a model in which we position ourselves as a facilitator and as a conduit to attract capital to impactful projects in Latin America. And that requires a transformation on how we organize ourselves, our processes, our institutional organization. I was telling Suzanne, we are creating, for instance, and it was been said here when we talked about policy, and Suzanne mentioned the countries, we are creating, even though we finance the private sector, we're creating a full department on regions and countries to step up our dialogues with government so that we can better understand where the policy or regulatory failures are, and we can go to the IDB and say, guys, you need to work on this, or we can tap into the World Bank and say, no, are you working with the government in Brazil on this? Can you help us with that? Because that would be the enabling conditions so that we can bring more private capital into those projects.
Very good. Now to the EIB.
Thank you. Listen, just to set the context, and I can come in new and fresh and not take any of the blame for the history of this, but with EIB, we've got a lot of work to do, because when I look at EIB's business, not just the business I look after outside of the EU, but also inside of the EU, which is the much bigger business, obviously, for EIB, we probably do about 80 to 90 billion in new investments every year, maybe across 600-700 projects. I would say the number of times we touch in those projects the insurance investors or pension investors, I could count in probably one hand, honestly. And I asked myself the question coming in, is it us or is it you? who, you know, and it's a bit of both, okay? It's a bit of both. Us, there's a big incentive challenge, I think, in a lot of MDBs and perhaps particularly EIB. Even the fact that I mentioned the figure, we do 80 billion a year, 90 billion, you know, it's all about how much we do of direct financing ourselves. You know, that's our kind of calling card, it's our motivation, it's our, we're big, we do a lot. Is that how we should be measuring ourselves? Is that how we should be incentivizing our organization? Is that how we should be rewarding people inside of the organization? Probably not when you look at the scale of financing that's required. It should be a different culture, different organization, different incentive system. It's probably a little bit of the other investors as well, because when we look at the projects we finance, we have to finance new capital formation only, new investments, greenfield. When I look at the private investment community, I'm not seeing a lot of risk appetite for development risk among institutional investors, quite honestly. Post-greenfield, brownfield assets, post-completion, recycle, absolutely. You know, and there's much more space for us to do work in that area. But greenfield asset creation in emerging markets, I'm not sure. And so we need to be realistic, I think, about where we're trying to mobilize the private sector, which parts of the private sector into what assets. And I think also commercial banks have a fundamental role to play in this space as well. And there's also big issues around the regulation of commercial banks and the reduction in risk appetite for commercial banks in emerging markets in particular.
Mohammed, you're the IFC is the private sector branch of the World Bank. Maybe is this new for you, or are you already ahead of all these others, or tell us a little bit of your work and how that fits within the World Bank group and how you differ or similarity with the other speakers.
So I'd like to first maybe congratulate ILX and Manfred for, and you earlier referred to, maybe we will be creating a new asset class, but I think it has been created. There's an MDB asset class. I think ILX clearly is in that space, and I would say they are the aggregators. So Manfred, kudos to you and your team. If I may, I think we can claim a little bit to that success in a couple of ways. One, the GEMS data, which underpins really the performance of this asset class. We contribute maybe 40 or 50% of that data, the private sector, to the data set. And I think number two, we are I would say the number one contributor to Manfred's portfolio, which he's financing through the ILX platform. Having said that, no, I think we have a lot in common. I think maybe the one difference is that as an organization, we were originally created to deal purely with the private sector. And so we did not have a public sector mandate to begin with. Even though we have, and we are part of the World Bank Group, and EBRD and IDA and MEGA are part of the group. I'm also, I think, going to make a little bit of a case for why the private sector should actually work with this group. I think, number one, we are impact-driven. So what we offer is impact. I think, number two, we look and play the long game. We don't go into these countries. We are not hot money. We are not portfolio flows in and out. We are not carry traders. We actually go in there and make people's life, and we contribute to improving people's lives. So that's one another reason. The third reason is we actually have presence on the ground. We have people on the ground, and these people originate and develop businesses. But we also have expertise on the ground. We have actually sector and industry specialists in a lot of these countries. Just to give you an example, we have over 30 offices in Africa with staff, and these are operational staff. These are not people who, only handle government relationships. And the type of knowledge you acquire on the ground, the type of relationships you develop, and again, talking about the relationships, we are there in good times, but we are also there when times are not so good. So the kind of relationships, the trust you develop in the local economy and the local sponsors and the local promoters in the private sector is a fairly deep one. It's not superficial, and it's not transaction-driven only. We are there, and they know us, and we're there for the long time. So this is some of the reasons why I think that this group here, as an asset class, adds value that no one else has.
And maybe one follow-up question before I go to the pension funds. Is there risk that is thought to be taken in the Global South right-sized? Because the cost of finance is very high. It all has to do with de-risking mechanisms that are overpriced. And eventually I talked also to the president of the Africa Development Bank, who's not here, but he said, we're doing great. We are making a good return of investment, and the risks are not as bad as perceived from the onset, and that's something that is not known on the private sector's finance side. Is that a right assessment? Yes or no? I don't know who wants to maybe react.
So there's definitely a gap in risk perception, but it would be very difficult for me to go and talk to a fund manager or a pension fund and tell them that there are no risks. Clearly there are risks, just like there are risks in developed markets. I happen to have had dinner a few months back with a group of pension fund managers who allocate not a lot to emerging markets, and I said to them that I do understand where you come from. I understand that you have fiduciary responsibility managing people's pensions, and the importance of making sure that what you invest is protected against risk. But what I said to them was, your asset allocation models can also be tweaked, in the sense that when you look at these markets, when you look at developed markets, and I was in the UK at the time, so I was with UK pension fund managers. I said, when you look at the UK and you are deploying in the UK and you are buying UK government gilts, you feel that you don't have any risk until you have a crisis, and all of a sudden, interest rates are very low. You are coming up with a liability-driven investments. You are leveraging, and then one day interest rates go up, and you have to post 150 billion pounds of collateral. And then what do? You don't see that risk coming when you are in developed countries. You see them when they materialize, whereas in developing countries, you actually see the risk coming and you can mitigate.
So it's interesting. We normally say you rather go for the risk you know than that you don't know, but you're saying actually in developed countries where you feel comfortable, you don't see it coming. In developing country, you're totally on edge because you know something will always happen. Interesting. So now any other comments on this? And otherwise, yeah, go ahead.
Well, I mean, just to say that I think it's absolutely true that risks are perceived to be higher than they actually are, and the whole point of the work that the MDBs have been doing in terms of the GEMS database and publishing data, the whole point is to demonstrate that default rates, recovery rates are a lot better than is perceived. But of course, that's not to say that there aren't risks, and we as MDBs, we necessarily, our mission is to work in difficult places. So there are risks, but I think it's absolutely true that the market perceives them to be higher than they really are. Also, the point that was made earlier about the importance of local presence and local knowledge on the ground, that's very, very critical.
If I could just augment that, I was just going to to your point, it's about data and understanding of what's going on. So the GEMS and the release of some of the information on the GEMS database has been instrumental in providing those levels of comfort. But even in still, so at Asian Development Bank, we see, parts of the world, for example, in the Pacific, in talking about the South, there isn't enough investment there. And what the conundrum there is that you have countries which are, rated highly, but they're still considered too risky for investment. And so what do? You need to use different instruments, a differentiated approach. You need to bring in different kinds of capital for that, to be a facilitator for that. And so, there's different ways of approaching that. But I think that what I really like what IDB Invest is doing is really an originate to distribute model. So you then take the front end risk. It's a different way. Of course, you need then to look at your own balance sheets from an MDB, because that's not how we're structured. Your, finance, or corporate and project finance, animals that have, utility-like returns that you're looking for. So that requires a different utilization of your balance sheet. And I think that's a really interesting discussion that's going now. And I have to give Manfred a little kudos on ILX. We had discussions at the very beginning when you're talking about setting it up and basing it upon a previous model when I was at Cordia Capital. So I think that, that model and also the linkage with the GEMS database provides a credible a way of distributing and accessing private capital, because the private capital is risk adverse by nature. So you need to provide those pathways for them to invest.
So what I'll do is I'll ask now the pension funds, but then I'll go to Manfred just to quickly make a quick cameo, because we're online on YouTube, etc., to then explain what that all means and what he's doing. He's bridging the world between the pension funds and all these MDBs. So there's huge opportunities there on the ground to be invested in, and those hungry to find good investments to bridge that world and through ILX fund. But I'll let you explain it to you in a second. But now would like to go to the pension funds, and maybe I'll start with you, Anders, and then to you, Enrich or Enrik in Canadian. But why is it not happening? So you have all that investments. Is that because you go easy, you go to the markets you're part of the flow of the vested interest, and you're not flowing? Or is there a limit of your government that you're not allowed to invest in the global south? What's hampering, and what is needed to unlock this finance?
Thank you. I think I'm going to start with the positive sides of what is happening, and then go to the barriers and the difficulties, because in the conversations outside of COP, those difficulties and those things often overcloud the good things that are happening. And I will start by saying we are, as a pension fund, we are categorized as an asset owner. But there's an important detail to that, being a commercial pension fund, is that we don't really own the assets. We're guarding them for 420,000 different customers in Denmark. So we have to look after their interest, and the regulator says as well under which conditions can we do that. And one of the conditions is that we have to always make sure that we get the best possible return for the customers, no matter if there's an impact or not. So impact cannot come before the financial return. That being said, my experience the last 3 years is that in the blended finance structure, you can actually get both. You can get the attractive return. You can actually, there's been a lot of talk about this greenium, the negative risk premium that you have to pay in order to invest green. With the right structure, you can actually get a first move advantage and get attractive returns. But getting there is to think outside of the box, and like you so beautifully said, you have to leave the main road and think outside of the box in more specific projects that not all investors pursue. And we've done that with blended finance in cooperation with the World Bank previously, looking at waste reduction, looking at water purifiers and so on. So it is possible. Some of the barriers are, of course, that investment management and portfolio construction, in theory, really hasn't changed the last 30 years. We're still operating in these silos where emerging market equity is here, emerging market debt is here, but the structures within that fall between two chairs. And because there are so many investment possibilities outside of the green field that that the last 10 years delivered the return, there hasn't really been a pressure for us to move over there. So I would say thinking into these structures actually would give you the opposite of the greenium. You could get attractive returns.
Thank you very much. Enric, Canada, is Canada open for these kind of things? Different pension holders, different political reality? Go ahead.
No, sure. Let me start by saying that we already do invest a lot in emerging markets, in infrastructure and energy in particular, like billions of dollars. In fact, if you look at the combined investments of the Maple 8 or the Maple 11, now there's the Canadian pension funds, it's in the many, many billions of dollars, and many of us are in the top 10 or top 20 private investors in infrastructure in the world. So first, we need to dispel the myth that it isn't happening. It's just that it's happening in very particular sectors in very particular countries. Okay, so that's one thing. And now to look at some of the obstacles for it spreading to more things. I'm not going to repeat a lot of what's already been said because most of the things have been identified, but a few that I haven't heard yet is one is the reality that the high interest rate environment in the advanced economies puts a huge hurdle. So now when we were earning 2, 3, 4, whatever percent, a marginal increase in that, by investing in an emerging market that we didn't know very well, that would be very attractive. But when you can earn almost the same rate investing in our own backyard, well, of course you're going to choose the easier one because you always go where you know. So we do have to recognize that just the macroeconomic condition of a high interest rate environment in, let's call them the OECD countries, like that's a big obstacle, so we need to think through. And that's actually where data really comes in to be important, because one of the benefits of the GEMS database and all this and that is to actually lower the risk premium, right? So that there isn't the need for such a big gap, and it lowers the cost of capital in emerging markets. So that's one element of it. I think another one that I haven't heard that much about, but it is a big issue, especially for the big institutional investors, is we need large ticket sizes. So we can't invest in the a lot of the smaller projects. So it becomes difficult to aggregate them. And related to that, insufficient pipeline often the case. Not that there's no pipeline, there obviously is, or we wouldn't already be investing in it. But in a lot of particular markets and a lot of particular sectors, there just isn't that pipeline. And that's not exclusive to emerging markets. We're having a hard time finding low carbon pipeline even in our own economies. We have very ambitious targets for holding X amount of green assets, so 54 billion, lowering our own emissions from our own portfolio, even in our home geographies of, in Quebec or in the United States, finding those big ticket investments in an environment where, if we're honest, like Canada and the US, the emissions are still increasing. So we're lowering our emissions in an environment where emissions are increasing. So it's harder and harder to find those, that pipeline of quality projects, and that problem, exists even more in a lot of the emerging economies. So
But would that not push you, because you want to find good investments, to then look beyond the usual suspects to invest elsewhere?
100%, which is why we're trying to push so hard for more blended finance vehicles, why we're advocating at the G20, the B20, all these forums for creation of more pools of catalytic capital, for more technical assistance to be deployed and to develop the project pipeline, for the release of the GEMS database and other things like that. It's exactly why.
Is blended the only way forward, or can there be just direct loans as well?
No, of course. As I started on the onset, we already do a lot of direct investing without any involvement of the MDBs. There's a lot of markets where we have long established presence and we're comfortable. Brazil, India, etc. It's really trying to get to those next markets where that are not as well serviced by the existing investors.
Thank you very much. Now I would like to give the word to Manfred, and maybe you can stand up and just explain in 3 minutes ILX and how you try to bridge these two worlds.
Thank you, Jaime, and thank you for all the compliments. Thank you, but I think for ILX we're relatively it's over 2 years old now, or nearly 3 years old, come January. But what we have to do is to bring together the pipeline of the MDBs, which is significant. But the issue is it's not something that you find on Bloomberg, because the pipeline is there for the internal workings, is not really for the external work. And this is beginning to change. But the pipeline is significant. 120 billion climate finance a year is significant. 65 billion mobilization per year is significant and is more than enough for us as a representative of Europe's largest pension fund to be able to allocate in very, very strong projects. And it's not a dream, it's not innovation, it's not something that might happen in the future or we need to, huddle around again in Brazil in 12 months' time to think about it again. No, it has happened already. Just looking with the IDB, we have done renewable projects in the Dominican Republic, with the Asian Development Bank in Uzbekistan, with the EBRD in Absheron-Kizi, which is 40 kilometers from Baku. We've done a renewable project together with Aqua Power, and with the IFC, as Mohammed said, we've done all fascinating projects in all regions of the world, and the IB we will in the future. But this is reality, and we're doing it on behalf of the pension funds in the Netherlands and now also in Denmark that have the highest standards of regulation, that have the highest standards of impact investment and allocation. The data has been unlocked. You can all go online now to watch the credit history of development finance globally in the past 30 years. It's real. And I think it's also, I mentioned this morning at another panel, it's about trusting each other. Yes, no, we're not the, sorry, yes, no. We are not the New York Stock Exchange or the London Stock Exchange. We're not the traditional market venue. But the MDBs are international financial institutions. They have the highest reputation. They've got incredible privileges and immunities that our investors benefit from. And the returns, are looking back over the past 3 years, what our investors have earned of course, it's still only very young, but has outperformed all other of their credit asset classes. So no, that's not something a prediction of the future, because you will not continue to outperform. That's been the past years. But again, it's about data unlocking. This data is not yet fully there. But we are. And so the last question is, what is the scale? I think the scale is very significant because the multilateral development banks, they're AAA rated. We're doing direct contracts through them, and this is a bit technical, but the scalability is very significant. The pension systems in Europe and North America and Asia are very significant. This could be a solution, but I think we have to trust each other, not live in fear. And I want to make a point on blending. I've had a lot of financial markets, and blending is what caused the financial crisis. It was a lack of transparency that caused the financial crisis. So we need to be very careful at introducing blending as a solution for the financial system. It's a solution for the poor countries. It's a solution for very, very high risk, but it is not a solution for example, middle. So I make a point because I feel that blending is now being used as the be-all and the solution to all problems. I think it is a seriously important issue for the fragile states, low-income countries, very difficult technology. But please, let we scale up development finance in its core, in its purity, which I think you'll refer to.
Thank you, Manfred. So now everybody knows Manfred. He used to be CFO of EBRD for 10 years, so that's where his experience comes from, and that's why he can bridge so well between the MDBs and now the pension fund. And pension funds, by the way, are my money too, because it's also the Dutch pension fund with the Dutch government's pensions are now investing via LICs in MDBs globally. And if you look at it, it went from 1 billion to 1.7 billion at this COP, and now not just us but also Danish companies. So the trust in this is actually increasing, and the potential again is quite substantial, because for the Dutch pension funds, which are amongst the biggest in the world, this is just a fraction. How big are the Dutch pension funds again?
They have $2 trillion assets under management.
There we go. So this is also, if you look at the risk appetite, it's also for the Dutch pension funds to get used to train their people to be able to understand how to invest through ILX into MDBs. That is important. My next question is to all. What is needed from institutions such as MDBs, IDFIs, to scale up institutional investors' confidence in the development finance asset class? And maybe I'll start with the pension funds here, and then move there. And you can be critical.
So the problem with this panel is you have all the A students here, right? No, you do. Like you have all the top performers. talking about how much they're leveraging, what, 3, 2, 4. The reality is most MDBs wouldn't get this A grade. You know, they're much lower performers. And so I think as a whole, the MDB system in its totality hasn't totally taken on this as the priority yet the way these particular representatives have. I know many of them personally. So, which is why I still think it's important, and I've even been saying this in the negotiation rooms just down the hall in the plenaries where they're discussing the NCQG. It'd be good to have a global target where the MDBs collectively seek to mobilize, you know, I think it should be up to at least $5 of private capital for every dollar of public they have. And we have good models, IDB, Invest, ADB, we they're right here. We've convened them. And so to learn for the other MDBs and the other development finance institutions and to really set that as the global target for all of them, like that would make a real difference.
So as a climate envoy, I need to bring this back into the negotiation. I think I like it. I like it. Please.
Thank you. Very good point. I like that one. And besides that, I would mention data. We would need reporting that clarifies and bring transparency of what kind of impact has this actually made. So that we're moving ahead. It's getting better, but we could improve that even further. And then the important role, of course, would be for you to find the projects. So you are the link between the pension funds and the actual projects. And the first thing I mentioned during the first question as well would be the open-mindedness to make tailor-made structures and solutions.
So, Gabriel, you were already hailed to have the solutions. How do you respond to this goal of
I hope my boss, whom Mohammed knows well, doesn't listen to him because he's already pushing us to go 3, and if he hears 5, we're gonna have to double work. But that's fine. I think that's a great challenge. And by the way, kudos to Manfred and to CDPQ because he talked about the project in the Dominican Republic. It wasn't an easy deal. But no, it came together. CDPQ has invested with us with some very complicated projects, for instance, in Colombia, and that's an indication that pension funds do have, when they have the right partners and the right information, and again, highlighting the importance of data, they can come along. One other point that to get to 5, I think we have to be more. And I think Manfred also mentioned that. I think first, as MDBs, we need to leave our institutional vanity behind, right? And someone talked about my own account, and really be able to open up our heart and our balance sheets to work with others. I would like to highlight the work that we are doing in the Amazon with the IFC. We sat down and said, look, we shouldn't be competing here, should be complementing. And basically, we have a deal in which we share everything. We give each other the option to come along, and everything we finance in the Amazon, and it's working great. That's one possibility. The other one is really listening to the investors and augmenting our menu of financial products so that we can play to different interests and be innovative. For instance, just 2 weeks ago, we were the first MDB to securitize $1 billion from our portfolio, and that freed up $500 million that we're going to reinvest in impactful projects, primarily on climate and GDI-driven projects. So I think, and again, this is not propaganda. This is something that and others are doing. The IFC is doing great things, and the other banks, and Suzanne has some great ideas in Asia. So I think we need to share information, share data, work together, leave vanity behind, and really listen to what investors want. Because we have this tendency to be a bit arrogant and say, well, this is my shelf, you can pick from it. We have to change that and say, okay, what do you need? What do you want? And can I develop something in my shelf that tenders to your interests?
But were MDBs a bit too lazy because they got government money and they never had to lure in the private sector in?
Well, I don't think so. No, look, I worked in the World Bank for 15 years, and I never thought we were lazy. I think we're heavy sometimes, big sometimes. No, IDB Invest, I can guarantee you that we are not lazy. And one thing about government money, we just went through a process of approval of this transformation that came along with a substantial capital increase. And the interesting thing is that what our shareholders have told us very clearly was, we are not giving you more capital to do more of the same. We're giving you more capital to be different, to take more risk, to do different things. And I think that's what our shareholders are instigating all of us to do. So we can't be lazy. We can't sit and because I think we are going to be accountable. And we've heard the call from the G20 last year in India. So I think we are all going to be accountable to our shareholders to demonstrate that we are able to transform ourselves and push the envelope.
We had a discussion with Mafalda Duarte, the executive director of the GCF, the Green Climate Fund, as well, and also she's under pressure to deliver more and better. And I hear all of you as well saying the same thing. So actually, the pressure that has been building up through the COPs and awareness on climate and the SDGs has been actually reaching the ears of the MDBs, and MDBs often have 6 goals to reach or more. So it's been difficult to shift also your priorities and to see where the balance lies. And of course, many of these issues are interrelated with climate, so you can also blend your objectives going forward. But Suzanne, please go ahead.
Yeah, no, some very interesting points raised. But I think that one of the things, if you could call it sweat equity, you need to sweat your balance sheets just a little bit more. And I don't think that the MDBs, we have very, many of our shareholders, donors are exactly the same. And I think that there's sometimes...
Explain sweat equity.
Okay, so I'm looking at it from the perspective is that, so last year, ADB, they reviewed their capital adequacy framework, and because it was very conservative, without a capital increase, we increased our capital available $10 billion per year without a capital increase. And so that means to me that, I'm not criticizing or anything, but I'm just saying that when you reevaluate the tools and what you have in front of you, there is more that you can do. And I do think a combination of that and also working together more because we have common objectives. And I think that in my years of working in the private sector side of development finance, I see more areas of collaboration than ever has existed before. And I think that it's about a common goal. It's also about... We know that from a climate perspective, it's going to be the private sector that has, ultimately the innovation and the capital. So how do we facilitate that, and how do we look and see where the opportunities are and create avenues for growth? For the volumes that are needed, it will be platforms. It's not going to be, you will be able to do individual transactions, but creating credible platforms that can, where you can come in and de-risk. And so, Manfred, I'm very cognizant of your term on blended finance, but from a de-risking tool without a market distortionary tool that is very important in some of these markets, creating those pathways for growth and bringing in private capital.
Very good. And Mark, from the EBRD perspective.
Well, thank you very much. I really like the challenge on mobilisation. I think that's really good, and I think actually what Andrew said about incentives earlier is really important. We are project-based institutions. We incentivise our staff in terms of annual investment volumes, and we need to kind of raise the sights and focus more. And whether we should have an ambitious target or not is a question, but we need to really incentivise our staff to focus more on private mobilisation. So if you think about the EBRD's mandate, the EBRD has a mandate to support countries become sustainable market-based economies. If we can work with a country to help create the conditions where the private sector is investing in the climate transition, that's pretty close to success. I mean, that's pretty good. So the focus on private mobilisation is really important. There are some big challenges around data and how we measure private mobilisation. Yes, we produce joint numbers in the MDB Climate Finance Report, but internally we all have different ways of measuring it, and that creates a lot of kind of confusion, and we need to kind of cut through that. And we also need to be honest. Some of the things that we count as private sector mobilisation, it's debatable whether they would or wouldn't have happened without us. Some of the things that we count as private mobilisation are genuinely really impactful, and we have incredibly strong stories we can tell. So we need to kind of recognise the fact that within the numbers there's a kind of variability of quality. I think sorry, I don't want to go on too long, but just to reflect on the broader question of what needs to be done. I think what's evident from this conversation is that there are lots of things that need to be done. There's no simple single solution. Sometimes when we talk about mobilizing the private sector, it depends which group you're in, but some group will say it's all about regulation, another group will say it's all about, the pension funds need to be more ambitious. Others will say the MDBs need to take more risks, or it's all about, the countries where we're working and them needing to sort out their business environments, their investment environments. It's a combination of all of those things that's important. There's a very good base because we're not starting from zero. It is already happening, but we need to build on that. But we shouldn't pretend that there's one simple solution and then suddenly trillions will start flowing. All of us have to work together on this.
Absolutely. Mohammed.
Just to say that I think Mark said that these are the A-grade students here, and I have to say that CDBQ is actually, when it comes to investing in emerging markets, one of the premier pension funds that actually has taken that to heart and does that effectively. Couple of things about mobilization, and I didn't talk about IFC's mobilization because this is something we've been doing for a very long time. But someone said, and I think it was either you or one of our pension fund colleagues, you need scale. And you need not just scale, but you need some level of standardization. And you need also issuance that comes to the market in a predictable way every year. You're not going to invest once in a blue moon, something that comes up, and that's the end of that story. It just takes too much transaction cost related to that. So what do, as MDBs, we need to do more? First of all, we need to innovate. And when I say innovate, I'm talking about structures that lend themselves to attracting people like pension funds. We need to standardize because that leads, standardization is something that's important. All that to originate so that we can distribute. I think what you also get here is diversification, and it's important. So by presenting not only individual projects, but pools of projects as an asset class that's well diversified is something that is important. And I think as MDBs, what we should keep in mind is when we set up platforms, we should not set up platforms just for one MDB. We should have it in such a way that, for example, IDB Invest, who only originates in LAC and Caribbean, can join a platform that IFC has that's global and that provides that diversification that would be even more attractive to investors. We talked about capital, and you said yourself, we get capital from the governments. What I can tell you is that IFC, in our existence, we have close to $40 billion in net worth today, of which, since our inception, we only got $5 billion from shareholders. So close to...
Well done.
Yeah. So you can actually, that's how you show profitability. And the last thing I would like to say is, you have the data, you have the GEMS data. I think there is something really that we need to point to that data. And that's the recovery, not the default, but the recovery data. And when you look at the recovery data, that's where it's much higher than you would see in the private sector. Why? Again, here, because we are in the long game. We believe in going concern. We believe in working out. We believe in restructuring. That way, you also have happy clients and projects that continue to have development impact rather than liquidating them. And you get paid back. Recovery is good.
Mohammed, if I listen to you, the future is bright. And also the collaboration. I mean, if you all know to each other and I see a lot of friendliness, etc., if you can co-invest into each other's projects and piggyback on each other's platforms, then that's going to be quite an interesting, I presume, but we'll hear from the pension funds as a reaction to what you've said. If that's more interesting, I presume it is because you diversify your risk. But go ahead.
Well, briefly, I mean, thank you very much, Derek, for the A grade, but I have to hand it back, because I think we've got a lot of work to do, and there's a lot we need to learn in EIB from our peer institutions who are further down the road in this journey. This has to happen. Private sector mobilization is absolutely essential. Do not underestimate how difficult this is for the MDBs to change their business model. Direct financing, absolutely, we're well down the track on that. Moving to an originate and distribution model is a fundamental overhaul of the MDB business model. Fundamental. It's a complete transformation, as I'm sure IDB Invest is realizing. It's a complete challenge to the financial sustainability model of MDBs, who originate transactions in a very expensive way and then hold on to them in order to earn a return. And how to develop a financial model that allows MDBs to be financially sustainable while distributing the assets in the most profitable phase to the private sector is a fundamental transformation. And that's why, to make that transformation, we need a huge push from our shareholders and other stakeholders, because as much as we want to do this ourselves, we won't always do it ourselves unless we get that push.
Well, thank you very much. Just because of the dynamics of the COP, I mean, people are pulled in or out all the time. So Enric needs to jump out. He's in the hot seat. Just give you 2 seconds to say something, and then I'll let you go.
Thank you so much. So the point I wanted to raise, and Mohammed stole it, so it's okay, he had it. The standardization piece is so important. You know, Manfred, if you asked him how many hours of blood, sweat, and tears he had put in to actually create ILX, astonished. And it's the same thing for any other of these funds that are out there. You know, FinDef Canada is doing one with MUFG. These take years to develop. You know, any of the other Allianz, BlackRock, and that needs to be streamlined. We need to be able to scale that up, mass produce it almost like on an assembly line. If every one of those takes 2-3 years, you have teams of people, you have all the different reporting requirements for every source of catalytic capital. No, it'll be a bespoke one-off thing. It'll be a nice, you know, unicorn you can put in your, you know, museum or something, and then you'll go off and you do your regular product. So yes, the standardization piece, I couldn't agree more, and congratulations again, Manfred, well done.
And thank you so much for joining us. So maybe you want to take over. You've heard them speak. Do you want to add anything from your perspective?
Just one comment. I would say the development banks have a capital constraint. So the capital that you have to use the most efficient way, and that is why the structures that we've looked into, for example, we've done 4 outcome bonds where the development banks as the first loss provisions, which is a helpful way to lower the risk and make the projects and the investment opportunities attractive from a pension fund of view. And I think together in those structures, we could look into mitigating some of those financial needs that are in this area. So the risk sharing and the first law provisions is an important thing for us to get the capital moving.
A quick question to Victoria about the reporting.
Yeah, thank you, Anders. I think one of your needs from the MDBs was on reporting and on impact reporting. And well, yeah, so that's one of my responsibilities at ILX is to really standardize, aggregate the impact reporting of all of the MDBs that are here. And I will have to say that it is very rich. They have very developed theories of change. So the IFC's AIM theory of change is one of them, but IDB Invest also has theory of change. So every single one of these have developed these theories of change to really quantify what is the impact of their investments. They are the original impact investors, and they have to report on this to their shareholders because they have to use public money to make this impact, and taxpayers want to know how their money is being used. So if you want the best-in-class impact data, you have that before you. Thank you.
Thank you so much for that comment.
There we go. And Victoria is already lined up to be the successor of Manfred because he said, you know, she has 40 years of career ahead of her. So so this is intergenerational leadership right here. No, that's wonderful. I just wanted to go quickly to last round before we go to Q&A with all of you. But I wanted to ask what commitments can you make, and maybe I'll start with you.
Oh gosh. Look, very practically, we're in discussions with Manfred and the team. We want to get on this train, so that's the commitment we'll make today. Thank you.
I think we have our North Star in terms of where we want to see our mobilization. I think we are very much committed and are working on more standardization. We have already tested few things out in the market. And for me, the best test is when you innovate something and you are holding it. And it is actually a mezzanine instrument. And you are able then to sell it down to a pension fund who is going to buy that and has bought it. And you've passed the market test. And that is the kind of structures that you want to do. And finally, I would say we would like to see more investments in junior and mezzanine pieces, because that's where you get the highest level of mobilization from everything that you mobilize above you, and in local currency, where we can provide the swaps, and pension funds or Manfred can come in tomorrow and say, I'm investing in those.
Thank you.
So a difficult question in terms of what commitments we can make, but I can say that EBRD we're working on our priorities for our next strategy period, and private sector mobilisation will be front and centre of that. Let's see what we can do in terms of kind of specifics of that, but it'll be central to our new strategy. And then just to respond on impact, I think that's absolutely right, and we at EBRD we're very focused on improving our impact reporting even further. I think we need to do a better job in terms of describing to our shareholders, to taxpayers, what we achieve, and there is lots of work going on between the MDBs in terms of how we can align those metrics.
Very good, thank you. So.
Just to continue on with the discussion, so we're in the process from the private sector side of ADB to scale up what we're doing about 3 or 4 times. So that, and a fundamental part of that is mobilization. So we're having, again, new strategy and all this other kind of stuff put in. But it also is, our ambition is to innovate, be a market maker, so that you can actually de-risk and create models that are replicable. And I think that's, one of the biggest things when you're coming in. So that's what we're planning to do.
Very good. Gabriel.
Some of the points that were made, standardization is one. Point that Victoria made, I think it was great. We are determined to be impact-driven bank, even more so than what we have been. Creativity and innovation is key for us because our train has sailed. We don't have an option right now, and what was said about the models that we need to use to make it work. So we're working very hard on this. But more than anything, Your Royal Highness, I promise you not to be lazy and work very hard on this.
Go ahead, Anders.
Thank you. I'm going to start by saying that making an impact besides the financial return is deeply rooted in our DNA and part of our values. So I'm going to use the analogy as I heard over here from the European Investment Bank. We are on that train, we're not getting off. So my commitment going forward is that we're going to keep on seeking these dialogue, looking for new structures, gaining an even larger exposure of the portfolio in this area. This is going to be a license to operate going forward, so we have to do that.
Fantastic, and I'm trying to get off the analogy of a pipeline of projects because the carpet pipeline is not the best analogy. But the train I like. It's going to be electric, and you can choose which track you take going forward. I'm going quickly to Q&As to see if there's questions. I know there's one here, but I first want to give the word to Louise Walker, who's the head of the private sector capital markets at FCDO. Go ahead.
Thank you very much, and thank you, Your Highness, for great moderation and some fantastic discussion here. And also a shareholder. It feels like we're on a new frontier as we're looking at risk offtake and originate to distribute and all the ways that we're looking at how to do business differently in order to mobilize the quantities of finance that we need. And it would be interesting to get your reflections on how ready you think your organization is, because this is your treasuries and your risk departments and your incentives, and it's, you know, as IDB Invest has talked about, it is a big transformation. So where are you, do you think, on the journey? We've sweated some balance sheets, but the revolution is upon us. So it'd be great to get your reflections on your own institutions. Thank you.
Who wants to comment on that?
Let me start. I think all of us have a lot of work to do responding to the question. Where we are at IDB Invest, we just launched a comprehensive reorganization of our institution. It's been announced, which in the MDB world may sound like a rhetoric, but I think in this case we're really trying to do things differently. We are in the process of revamping and adopting a new risk appetite policy. So this process is far advanced, and we have a commitment to bring that policy to the board during the first semester of next year. And the mode for that policy is a bolder risk appetite. So we know that's necessary. We are also revamping our impact framework. We call Delta, and it's well known in the market. We are revamping it completely to be more in line with current trends. And finally, we are revamping our whole set of processes and platforms, because part of this transformation that was mentioned here by EIB, it's not only what our treasury needs to do, but us being able to significantly increase the number of operations we do. And if we are to achieve that, I'm not talking necessarily volume. Yeah, the volume will increase, but the average ticket will probably decrease. We're going to have to do a lot more operations. So in order to do that, we can't treat all as the same. And, you know, MDBs, yeah, we have different platforms, but in reality, doing a $20 million project is almost as complicated as doing a $500 million project. And we are in the process of really getting different sets of delegations, both from management, but as well as now board. And hopefully that will also be approved in the first semester. Our goal, just to complement, is to be ready to launch the new model by January 2026. It was just approved. The capital is going to start to come in December 2025. So we need to be ready when that comes.
Go ahead.
Thanks. So last year, when the process started at ADB, where they launched, they call it a new operating model, and basically where you get the public and private, upstream, midstream, and downstream working together. It's a transformational that will take many years, because you need to reskill the entire organization, quite frankly, rebalance. Because the external environment and ADB, when it was established in 1966 as a sovereign infrastructure bank, the external environment has changed. So we're in the process. That's a journey. It requires, yes, different processes. That's another journey. But I think that there is a cognizant an awareness there that you have to do these things, because that is absolutely what is necessary and what is needed.
Well, thank you. No, I mean it's a great question. It's a difficult question to answer. We're at EBRD. We're as I said, we're going through the process of setting our objectives for our next strategy period. That's a very important debate. There's a very strong focus on both deepening our impact and on private sector mobilization. We're also going through an internal transformation process to make sure that we remain, flexible, agile, that we're fit for purpose. All of those things. You talked about revolutions. I mean, revolutions aren't always successful. So you can talk about either revolutions or evolutions, and I think yes, we very much accept that we need to move with the times, we need to adapt, we need to change our operating models. At the same time, there are some very strong things about our existing model, and we shouldn't throw those away. So we have to be careful about changing everything just for the sake of it, and we need to build on the successes of the past. And that's not at all to say that we shouldn't be ambitious.
A very good question, and I just would like to say one thing that maybe is not very obvious when you talk about IFC. So equity is a big part of our business, and equity is the ultimate mobilizer. Without equity, there is no project. Without equity, there is no leverage. And we are going to be doubling our equity business in the next 5 years. So that's one element. The second element is, as we speak today, 60% of our own economic capital is actually tied up in our equity positions. So talk about risk-taking. We have the DNA, I think. So it's the extension is going to be something that will require us to come up with new products and new ways of doing business, doing more mezzanine, doing more junior capital. But we do have the risk-taking DNA that comes with equity risk-taking. And when it comes to mobilization at IFC, the big number is, I can tell you this year, about for each dollar that is on our balance sheet, we mobilize about $1.2. But that number hides a lot of things. And what it doesn't tell you is that in more middle-income markets, it's more 1 to 3, 1 to 4, and more challenging markets is where you have less mobilization. So what we're working towards is how do you make sure that those more difficult markets, you get the mobilization up, and what do you need to do that?
Thank you.
Thank you for the question. And to be honest, I'd say we are at an early stage in our journey into this space in EIB Global in particular, but we are reviewing the strategy. Private sector mobilization is going to feature much more strongly in our new strategy. And that means we're going to have to look at some of our fundamental processes within the organization. Without getting too much into the internal cuisine, there are legal issues around originate to distribute in terms of the passing on of privileges and immunities, even for private sector operations. There's fundamental monitoring issues in terms of the portfolio. Who monitors the portfolio in this model, and what obligations we create for the MDB to private sector investors, and how that's funded. There are risk management issues. There is financial model issues in terms of how we make this pay, because at the end of the day, we have a treaty obligation to be financially sustainable. I don't want to get too much into all of those, but it is a complex process. We are at a relatively early stage. We look forward to learning more from our peers who are a little bit further down the track in this. And it's certainly my intention that we make progress in this in the coming years. Thank you.
Very good. I'm going to go to collect a couple of questions very quickly, and then short, snappy answers, and then I'll ask Manfred to wrap it up. Go ahead and introduce yourself.
Hello, I'm Mattia Romani. I'm with Systemic and a recovering EBRDer. I have a question that really fits your question very well, and it focuses on what Andrew just said. I mean, part of the originate and sell on and securitize model implies, yes, more mobilization. On the other side, you sell your balance sheet on to third parties, which means you got to use the capital to do more origination. So there's a lot more origination that needs to happen, and we know that's needed from the number of reports that have come out on the enormous needs. So this additional origination not only is going to cost money, so there's an issue of financial, because as we know, origination is expensive for IFIs, but also requires more projects on the ground and more pipeline. So my question for the panel is, how are we going to get this new projects financed? Where are they coming from? And are we really gearing up our GIFs at the World Bank or our institutions that are doing project preparation and building? Thank you.
Who wants to answer? Go ahead, Mohammed.
Excellent question. And I actually used to run the risk function at IFC, and when my old boss came to the job, he said, "What keeps you awake at night?" And I said, "Origination." So he was expecting me to talk about some risk factors. I think a couple of things. You're absolutely right. How much can you originate with the resources that are finite? So one has to think about not just how much we originate on our own, but how much we leverage others who originate, take what they originate, and put those in platforms that you can then recycle, enhance through a capital stack, and, for example, give what the pension funds need. Do they need a AA or a single A tranche, or do they need a triple B tranche? So, and look where the risk takers are and who likes what. But just relying on our own origination capability is not going to be sufficient. We have to use others who originate, but who have no appetite for keeping them on their balance sheet.
Anyone really yearning to answer? Yeah.
Just adding to, and Mohammed is absolutely correct, but there is also an issue of doing this, lowering our costs. In our case, in addition to augmenting our field presence to over 50% of the team, but not only the physical presence, transferring decision making to the countries. So it's going to be a lot less in DC, a lot more in the countries in terms of delegation, but also rely on others, not only within the MDBs, but also with the FIs. For instance, in our case, we have already signed agreements with, for instance, DFC, and we can use their due diligence and vice versa for certain classes of projects. We do the same with the IFC. With the IFC, we rely on theirs and vice versa on all classes of projects. So not only you have others originating with you or for you, but you also are able to lower your cost of origination if you're able to rely on partners that you trust.
I'm going to give the word to Mark, and then I'm going for two more questions here, and then back to you.
Just very quickly, it's a fantastic question, and it's we talk a lot about how to mobilize finance. We also need that supply of projects. We need that supply of high quality projects. That's why work on project preparation, the policy work that we do is so important in order to generate that pipeline of high quality projects.
Hi, thank you. I'm Valentina Ramirez from the Institutional Investors Group on Climate Change. And my question, first of all, thank you. It has been a fantastic panel. My question is one around convening and uniting voices, precisely to address some of the issues that were raised on the panel. So, yeah, what platforms or opportunities have you found useful in the past to, again, aggregate your voices on how to agree, for example, on capital mobilization metrics, or how to aggregate your voice on regulatory reforms that you identify that are necessary in different countries, or to listen to pension funds and what they need? Thank you.
I'm going to add this question, and then we go one more round, and then we go to Manfred.
Yes, thank you. Asker Garnak from the think tank Concito. Actually, a question along the same lines as the origination, but taking it a step further to the catalyzation. Because mobilization is fine and important. That is where you can have a sort of a visible impact on the private sector financing. But the more indirect actions in order to catalyze, including getting the institutional and regulatory policy frameworks in place in a country, that's even more challenging, I would assume, because how do you attribute your efforts to a specific impact which is market-wide, even though you collectively as MDBs, for example, through a country platform, have had an enormous impact. This quest for possibility of attributing to your specific efforts as part of the impact monitoring system, I call it the attribution curse, because it's really essential to get to the trillions, but it's hard for you to incentivize internally, right?
Very good. So each can have a very short reply, and then I go to Anders, and then to
Let me quickly take the last one, which I think is a great question, and it's both incredibly difficult and incredibly important. And I don't know what the answer to this is, but I think, clearly if we can collectively work in a country, improve institutions, improve the investment environment, that's a great thing to do. How can we claim the credit for that, or the attribution curse, as you say? I think we just have to be honest and tell the story that we've been working in a country and we're part of we've provided this support, and not be too ambitious in terms of claiming attribution, but tell the story of what's happened.
No, thank you. I think that it's very interesting, because I think that this is where the work of the upstream, midstream, and downstream comes together. Because as an MDB, again, with our many of us are involved in similar countries, so I do think that we need to coordinate more. We need to advise these governments and through our strategies and all the other things that we're doing, what are the impediments for investment, and help them along in those journeys. And therefore, if you're creating a better environment for investment, then that actually helps solve some of these other things. It's not a short-term thing, but it does involve serious engagement across governments and organizations.
Mohammed?
No, both questions are very good. I think on the first one, MDBs now do have a common mobilization principles that we all adhere to, so that when we say it's a mobilization, we know what we are talking about. It's a common principles that are agreed between the MDBs, so that we are comparing apples to apples. So on catalyzation, I think that's an excellent question. I'll give you an example. When you go to a country and there is no leasing legislation, and you go and you help the government set up that leasing legislation, but not only that, then subsequently you bring in the first transaction and the first investor to come and invest in the leasing. That's a demonstration, or the operationalization of that legislation. And then you look at that market, and if no other company does leasing, that's a failure. If you have 10 more companies and leasing takes off in that market, then you can attribute to what you have done.
Thank you for both great questions. Just to say, in EIB, we're a project financier, and we do conditionality at the project level, not at the policy level. But increasingly, we're involved in conversations with the other MDBs and the European Commission about the wider reform agenda. And clearly, we're using our experience in the projects that we finance to feed into those conversations, often at the European Commission level, about what the key policy changes are, leveraging from our experience required to catalyze even more capital into the projects that we have experience with. Thank you.
No, just one one quick reaction on what was said. No, the attribution. We need to get away from it, and I think it requires also. Somebody said at the beginning, changing the incentives, right? Internal incentives, so that we are not so hooked up on the attribution, but on the end result, on the impact, on the outcomes. And it just, Mohammed gave the example on leasing. We have at the IDB group one PPP unit across all institutions, so they are both public and private in nature. Just as an example, we have from over the past 3 years, the IFC has financed twice as much as we have on the PPPs that we have developed with government. And that's fine. That's fine. But that's fine for the unit as long as their set of incentives is not focused on what PPPs are financed by IDB Invest, but what PPPs come to the market.
Now, Anders, this is a different discussion. Any last word you want to give?
Just one thing that covers a bit all of the questions about origination and dependency upon each other. I would say that as an institutional pension fund, I have an investment department of 61 people, and I have not a single one that has experience with boots on the ground and project evaluation. So we're extremely dependent on all of these grade A guys who's sitting next to me here on combining these different things from the value chain. We are dependent on you on the boots on the ground, due diligence and so on, in order to deliver the regulatory requirements on monitoring risks and quantifying them.
Wonderful. Thank you very much. Before we give applause to them, we're going to ask Manfred to have some closing remarks.
Okay. Well, we could spend hours on the topic, and it just shows you how unbelievably rich the conversation was. I think it also demonstrates what a really a hidden gem, and that's so sad that you are a hidden gem. And it's really about making it more known of what the MDBs can do for these global pension savings. Yeah. And we're alive. It's not something we're dreaming of. It's something that exists today. But obviously, the scale up of your work that needs to happen. But you have such evidence of what you do on the ground, Mohammed. The little evidence of 5 billion turning into 40 billion is at the heart of the financial performance of the asset, and that's we also think that's very important for the pension funds. So these two things combined, we're working closely with other Dutch and Scandinavian pension fund. Louise, we're on this mission together to have the UK pension system join this journey. I mean, these are vast amounts of capital that really, I think, once they begin to understand what you all stand for, I think we'll join it. So we look forward to another 40 years of working together. I'll be retired, but Vicky will be 40 years older. Thank you very much. Where's Jaime? Jaime's there. He's hidden. Jaime, thank you much for excellent moderation. There's a new career beckoning for you as a talk show host. Huh? Thank you very much.
No, and a big thank you to all the panelists for joining us, and thank you all online for following us here and everybody here in the group. Thank you very much.